Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Liberation Day is upon us as Donald Trump slams massive tariffs on nearly every country in the world outside of a few rocks in the Pacific and the Vatican. Is it too early to dream of buying something at Walmart that is not made in China? So I've been calling these the nuclear tariffs, and indeed they were much bigger than markets or trade partners expected, with the Dow falling 4,000 points as globalized companies face the prospect of completely rebuilding their supply chains or paying billions on everything they import. Note that stock markets only represent existing globalized companies. They do not represent the future companies that will make it in America. In other words, the stock market is not the economy. Now, most countries got 10%, but our biggest trade partners got whacked. Europe got a 20% tariff. UK got the friend price of 10 thanks to Brexit. Canada and Mexico stay at 25, but note most of their exports are exempt from any tariffs under USMCA, Trump's NAFTA replacement. Japan, Korea, and Taiwan got rates between 24 and 32%. Even Israel got 17%. Vietnam, where Chinese companies hide out to avoid the old tariffs, got 46%, and China itself got 54% tariffs. That's the old 20 plus a new 34 on top. Now, Trump's formula was billed as capturing all the tariff and non-tariff barriers like currency manipulation. In reality, it was literally trade deficit divided by imports. So take our $63 billion deficit with Japan, divide by the $136 billion we import from Japan, and it's 46%. That's 63 over 136. Cut that in half, squint, and Trump called it 24% tariff on Japan. Mainstream economics professors had a field day making fun of the equation, but the logic's actually decent. If we have a deficit with you, find a way to fix it, buy our stuff, export less. We don't really care how you do it. Now, Trump billed the tariffs as ushering a golden age of trade parity that brings more investment and jobs to Americans. Stock market saw it different. The Dow fell nearly 7%. For perspective, the Dow fell a quarter in the first month of the 2008 crisis, closer to 30% in the first month of COVID. So 7 is not the end of the world, but it is pretty rough for 2 days. So what's next? The first question is whether Trump's playing art of the deal, using tariffs to get other countries to behave. Or is he genuinely trying to reindustrialize America? If it's art of the deal, it will work. Other countries will drop tariffs, with China and Europe putting up rearguard fights. On the other hand, reindustrialization needs 2 things. First, that the tariffs will last. If Trump's going to remove them next month, he can't build a factory on that. The other thing is reindustrialization needs major reforms to make it genuinely attractive to produce in America, as in mass repeal of crony regulations and big, beautiful tax cuts, especially for small business and manufacturing. Without regulatory and tax relief, tariffs alone will fail. The world is littered with failed tariff walls from Brazil to Africa, where they did not make it genuinely attractive to produce. Now, Trump and Doge are doing great on the regulatory front, even with Obama judges trying to fight democracy. But the other ball, taxes, is squarely in the court of Congress, which is a scary thought. How long will the dumpster fire in stocks last? Will we be papering the bathroom with NVIDIA preferred shares? Since Trump announced his tariffs last week, stocks have taken it on the chin, with the Dow losing 4,000 points, wiping out more than $5 trillion in paper wealth. Of course, this was concentrated among rich people. The wealthiest 1% of Americans own half of stocks. The richest 20% own 99.3%. Leaving 0.7 for the other 4/5 of Americans. Still, $5 trillion is a lot. Last week I mentioned how the top 10% of Americans make up nearly half of consumer spending. The bigger question is, how long will the pain last? For this, we can go back to 3 interesting episodes: the 2018 trade war with China for the base case, and for the worst case, 2 big tariff bills in the 1920s, the famous Smoot-Hawley tariffs of 1930, and the lesser-known but even bigger tariffs in the Fordney-McCumber Act of 1922. In short, the China tariffs say that markets heal within about 6 months, while the 2 big ones in the 20s say that what tariffs do to markets depends whether underlying economic policy is pro-business. So in modern terms, meaning cutting red tape, low business taxes, and cutting government spending. So jumping in March 2018, Trump went to war with China, starting with solar panels and washing machines, then expanding to $60 billion of Chinese goods. The S&P fell 2% immediately, then 6% over the following weeks, then another 2% when China retaliated on U.S. goods. But by September, stocks were back to where they'd been, while famously inflation was very tame contra the predictions of our free trade aristocracy. So that's the base case. What about the worst case? So the 1920s saw two big tariff bills, Ford-Macomber in 1922 and Smoot-Hawley in 1930. Smoot is universally cited to paint tariffs as economically catastrophic. After all, it was the Depression, and stocks fell by half within the year. But the Ford-Knee tariffs were even bigger. The tariff hike was twice Smoot, taking average rates to 40%. And stocks were actually up a year later. Industrial production is even more stark. A year after Smoot, it was down 29%. A year after Ford-Knee, it was up 5%. The difference, of course, was other economic policies. In the 1930s, Hoover and FDR were tag-teaming the banks into oblivion, and then they replaced the gold-backed dollar with money printers, the so-called rubber dollar that literally outlawed owning gold. Meanwhile, Hoover and FDR were threatening companies that either lowered prices or laid workers off, which essentially locked them into state-enforced bankruptcy given massive deflation from the collapse of the speculative bubble the Fed had blown. This all means Smoot gets blamed for the wider policy catastrophe. Ford-Knee, meanwhile, was signed by one of the most pro-business presidents of the 20th century, Warren G. Harding. He had run on reversing the socialist takeover of Woodrow Wilson to allow business to produce again, and then he was followed by the even more pro-business Calvin Coolidge, Silent Cal. So what's next? If Joe or Cackles had won, and we had these big tariffs, I'd be looking to Smoot with trepidation. But given Trump is doing everything possible to encourage investment and job creation, Ford-Knee is the much better comparison, meaning disruption and falling stock prices for existing globalized companies who will pay the tariffs, but an economy that comes back stronger than ever. A word from our lead sponsor, Unchained.com. In the new year, it's time to think about your annual IRA contributions. An IRA is an investment vehicle that can save you a lot of taxes. With Unchained, you can hold real Bitcoin in your IRA, get access to trading, inheritance, and loans, and it's the only company where you hold the keys and can verify that your Bitcoin is not being relent like banks do. We've seen futures-based ETFs underperform holding your own Bitcoin, so why settle for less? Book a friendly consultation at unchained.com/Peter. If you own gold or silver, you know they're a great hedge against financial instability and let you grow your wealth outside the banking system and gain greater control over your finances. Monetary Metals offers you the ability to increase your precious metal ounces every single month. Instead of paying to own metal, with Monetary Metals, you get paid 4% on your gold paid in more ounces. Now's the time to secure your wealth and build your legacy in an asset that the government cannot inflate away. Join thousands of investors earning interest in physical gold and silver every month with Monetary Metals. Visit monetarymetals.com/Peter to learn more. Now back to our show. Will Trump's tariffs drive America into a depression? Yesterday, I talked about the stock market. Today, it's the economy. After a near 10% drop in stocks, are we headed for a depression? In short, interest rates say no depression for America. Oil prices say maybe for everybody else. And Trump's art of the deal says it could all snap back better than ever. This past week's red wedding level stock crash was the biggest drop since COVID. Still, for perspective, in February 2018, the Dow dropped 8.5% in 2 days on rising bond yields. In August 2011, it also dropped 8.5% on a downgrade of U.S. debt. I'm guessing most investors don't remember either event because stocks came right back. Still, the left and globalists like the Wall Street Journal are pushing the narrative that tariffs will destroy the U.S. economy. Their favorite comparison is the 1930 Smoot-Hawley Tariff Act, which I mentioned yesterday is the wrong comparison, given what else was happening in the Depression. Still, Smoot is generally credited with hurting other countries, and this is a distinct possibility going by the 15% crash in oil prices. Oil generally goes down when global growth goes down. But what about the U.S.? So stock markets are at a surprisingly weak signal, partly because the Dow only includes existing globalized companies. It doesn't include future companies that spring up to make it in America. These globalized companies may be listed in America, but they're not really American. For the Dow Jones, roughly 64% of sales are overseas, while roughly 40% of U.S. imports are by those large companies, meaning almost half of the hundreds of billions paid in tariffs will be paid by those big companies. So yeah, they don't like tariffs. That makes the Dow a global indicator, not a U.S. indicator. To illustrate, roughly 80% of Apple products are made in China. If tariffs force Apple to move production to the U.S., Apple stock goes down because moving is expensive, but it's obviously good for the American economy. So forget stocks, we have to look at actual recession indicators. The gold standard is interest rate expectations. The reason is because the Fed slashes rates when there's a recession, and that dominates when inflation is low and falling, as it is now. So going to the numbers, Trump's tariffs raised the odds of a U.S. recession this year, but not by much. A month ago, markets were expecting year-end interest rates of 3.6%, which is nowhere near recession levels when rates go to zero. So where are we now after the nuclear tariffs and 4,000 points off the Dow? We're at 3.4. So yes, the odds of recession went up, perhaps from other countries going into recession or revenge tariffs, but they didn't go up by much. So what's next? Whether these tariffs cause a U.S. recession hinges on how other countries respond and how quickly Trump can bring production home. Zooming out, many countries have done very well with high tariffs. Historically, it's literally how Japan, Korea, and China got rich. In America's golden age, we had tariff rates of 57%, the Dingley Act. Toss in Trump replacing the income tax with tariffs in part or whole, and tariffs could create far more wealth than Wall Street just lost. Will the great trade war end in the great art of the deal? All week, the Dow Jones has been whipsawing plus or minus 1,000 points on rumors Trump might cut deals to end tariffs with major trade partners. On Monday, the Dow jumped 2,000 points in the space of 30 minutes on rumors and then gave it all back as it turned out to be fake news. Stocks made another break for it Tuesday, jumping 1,000 as Trump touted a perfect phone call with Korea on trade and ventured that China might call soon. In fact, more than 50 countries have already lined up to bend the knee and get rid of their tariffs if Trump ends ours, so-called zero for zero. And here we are just days into the tariffs, and so far India, Israel, Argentina and Salvador, Vietnam, Taiwan, and the EU have all offered zero for zero on tariffs. Taiwan threw in some major investment on top of the $165 billion Taiwan Semiconductors already promised to invest in American jobs. Japan is no doubt working it behind the scenes given how important exports are to their economy, while, of course, the U.S. protects them for free. The one big holdout is China, which is not used to hearing the word no. China's Ministry of Commerce recently promised to, quote, fight to the end. Notably, these fighting words did not come from President Xi Jinping, leaving open a calculated path to negotiations. This all brings us to the trillion-dollar question on tariffs. Is Trump running a worldwide art of the deal, pushing other countries to open up to American exports, or is Trump really trying to reindustrialize America? Damn the torpedoes. So Trump claims he's in it for the long haul, but you would say that. You got to pretend it doesn't hurt, or they'll just wait you out. Reality is probably between the two. Trump feels he promised jobs to fix the Rust Belt, and there's two ways to do that: increase exports or bring manufacturing home. Meaning if a country makes it sweet enough on exports, it ticks the box. If not, bring it home. The caveat is realistically Trump can only take the pain for about a year because of midterm elections. If the stock market is still in the gutter, or if tariffs are hitting inflation and supply chains, he loses Congress and gets 2 full years of Democrat lawfare. Now, a year is long enough to replace some imports by expanding domestic capacity, but it's not enough to full-on reindustrialize. Setting up a single factory can take longer, and import substitution factories will not even start until the trade situation stabilizes. So what's next? Trump is playing good cop, bad cop, pushing countries to come to the table while publicly musing how much he enjoys tariffs. Markets are expecting he'll cut deals with most countries, boosting American exports and pocketing another couple trillion of investment to boost domestic jobs. The biggest wild card is China, but keep in mind China competes with Korea or Vietnam and Mexico for that matter, meaning every deal Trump cuts is one more country eating China's lunch. That suggests even China will eventually bend the knee. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is Kite, maker of the famous block clock. Kite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's coinkite.com/ProfSaintAnge. In crypto, we read about new hacks every week with top coins spiraling into oblivion. Except for Bitcoin. It has never been hacked. The enormous innovations going into crypto will ultimately migrate to the gold standard of Bitcoin. Trammell Venture Partners is a Bitcoin-native venture capital firm that's been around since the beginning back in 2009. They back some of the top brands in the industry, including Kraken and Unchained. Check out the third annual report on Bitcoin-native startups, tracking nearly $1.2 billion in early-stage Bitcoin-native software startups. Visit tvp.fund. Now back to our show. Is America doomed to permanent trade deficits because we are the world's reserve currency? This is something called the Tariff dilemma, and it's been making the rounds since Trump's big, beautiful tariffs. In short, Tariff says that if you're the reserve currency, the rest of the world needs dollars. They can only get them by selling you more stuff than you sell them, a trade deficit. That gives them excess dollars, which they can save or use to back their banking system. So a number of commentators I normally respect have used this to criticize Trump, saying we have to run deficits. So this is false, because there's two ways for, say, Japan to get a hold of dollars. One is to sell us more cars. The other is to sell us their companies, real estate, and family jewels. If they sell us more cars, we lose jobs. But if they're selling us their companies, we are getting rich. Either way, they get the dollars. Interestingly, in the past 4 decades, the capital has actually gone against us. So foreigners own far more of America than we own of them. So not only does reserve currency status not require trade deficits, our cock trade policies have actually given foreigners too many dollars, to the point China and others park trillions in everything from treasuries to American farmland. So we can look to history for what a smart reserve currency policy looks like. The U.S. itself did not have trade deficits until the 1970s, and we were very much the world reserve currency in the 50s and 60s. How do we do it? By amassing overseas assets. By the mid-60s, we owned about 10% of GDP more than we owed, so about $3 trillion in modern terms. Even more dramatic, in the 1800s, the British pound was the world's reserve currency because Britain was fond of colonizing continents. By 1913, the UK had amassed roughly 160% of GDP in overseas assets, according to prominent economic historian Angus Maddison. These included railroads crisscrossing every country on Earth, massive oil fields in Persia and Arabia, diamond mines in Africa, sugar plantations in the Caribbean, and, of course, the Suez Canal. In modern U.S. terms, is equivalent to a $50 trillion surplus, close to $500,000 per household. Instead, today the U.S. is a net creditor. Foreigners own more of us to the tune of negative $26 trillion. And it got worse by $6.4 trillion in 2024 alone. So in raw dollars, Americans owed about $36 trillion overseas. That's half in foreign stocks and bonds, a third in foreign subsidiaries, factories, and real estate. The rest is loans and bank deposits. Meanwhile, foreigners own $62 trillion in this country, more than twice as much. That's 3 times as much in U.S. businesses and property, along with enough treasuries that markets panic if China sells some. So $26 trillion comes to roughly $200,000 per American household that we are in hock to foreigners. So it's nice. A reserve currency is a wondrous thing. It means foreigners give us cool stuff in return for paper we print in the Federal Reserve's basement. But after a half-century of politicians and unions treating manufacturing as an ATM while selling it down the river in bad trade deals, that reserve currency turned against us. It exported our jobs and pawned the entire country to foreigners. 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 The Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.